Greetings to one and all. You are listening to MMJC Updates. In today's edition, we will discuss about a consultation paper by SEBI, a couple of informal guidances, and a few FEMA orders. Firstly, let's look at the consultation paper. This consultation paper is issued by SEBI and is based on the Regulation 58(1)B. As of now, the Regulation 58(1)B mandates entities whose non-convertible securities are listed on recognized stock exchanges to send a hard copy of the annual report to its securities holders who have not so registered their email addresses with the entity. The proposed amendment mandates such entities to send a letter to such security holders which shall contain a QR code and a web link of the annual report. This initiative has been taken to support ease of doing business and for a better sustainable future. In the third amendment to LODR, which was on 12 December 2024, SEBI had amended the Regulation 36(1)B, which mandated equity listed entities to send such letters instead of full hard copies. The Regulation 58(1)B amendment has been brought to align with the Regulation 36(1)B. Moving on, we have the informal guidances. So the first one that we have here is CHL Ltd. Here, CHL was allotting compulsory convertible debentures and compulsory convertible preference shares to both its promoter as well as public shareholders. So the query that was raised was whether the promoters should be mandated to give an open offer under Regulation 3(1) of SAST. In its reply, SEBI has interpreted the word post-issue and has stated that the post here means after conversion of the securities. If you consider the holding of just the promoters, it would be increasing from 72% to 92%. That is a 20% hike post allotment. Therefore, the question arose that the open offer would be triggered or not. SEBI said, as the allotment was done to both public and promoters simultaneously, the post-issue capital should be considered on consolidated basis. So when we considered the consolidated basis, the shareholding of the promoters was actually decreasing by 0.96% instead of increasing. There was no need for an open offer to be triggered. Moving on, we have Pritish Nandy Communications. In this case, the promoters of the Pritish Nandy Communications acquired shares on 28 March 2025. Due to the trading holiday on 29, 30, 31st March, the shares were credited to the account of the promoters on 2nd April. So the question was whether the acquisition should be considered in FY 24-25 or 25-26. In which case, SEBI said that although the credit was done on 2nd April, the purpose of acquisition, that is the intent to acquire, was there on 28th March. Therefore, the question should be considered on, the acquisition should be considered on 28th March, and that the year of acquisition should be 24-25 and not 25-26. Therefore, the promoter should be allowed to further acquire 5% in 25-26 without triggering an open offer under SST. Let's move on to some FEMA orders passed by ED.
The first order passed by ED was against Myntra. ED had formed a view that Mrs. Myntra Designs Private Limited and its related companies were doing multi-brand retail trading in the guise of wholesale cash and carry trade. This was an alleged violation of FDI policy. Myntra had a group company, Mrs. Vector Ecom Private Limited, which was created to continue to be as corporate entity to bifurcate the B2C transactions into B2B transactions, thus disguising it into into trading, which was against the FDI policy. FDI policy also restricts more than 25% trading with group companies in case of wholesale cash and carry. Myntra had also failed to comply with the conditions as per the ED. Another order or another press release by ED was relating to One Sigma Technology, which also has its online mobile application One Sigma Technology had brought FDI from US by issuing convertible notes to a tune of around 264 crores. Business of the company was providing buy now and pay later facility through its mobile app, which would fall under financial activity as per the ED, where FDI should have been received under 100% approval route since SIMPL is unregulated entity. However, while bringing in FDI, SIMPL had declared or classified its business activity as benefits of IT and other computer service activity and brought in the money under automatic route. ED had formed a view that Sigma Technologies had received FDI under automatic route and issued convertible notes without obtaining prior approval from Government of India and thereby contravening the provisions under FEMA 1999, collectively to a tune of around 913 crores, and therefore rendered itself liable to be proceed under Section 13 of FEMA. That's all for the podcast today. Thank you for listening. We await your feedback.